this is Kim Camarda, and going forward, I'll be a regular contributor on This Week in Wealth. You probably don't, some of you out there may not know that I've been in the investments business for 30 years. Wow, that makes me sound old. So let's just say a long time. And most recently, I've been running the technical analytics group for the portfolio board here at Camarda. And a lot of the research I've been doing has been driving some of the changes that you've seen in your accounts. So Jeff thought it would be a good idea for me to take time on here and give you a little bit of deeper insight into why we're making the changes we're making. So here we go. A recap on obviously some recent events, the Senate runoff in Georgia, turning that a bit more blue, and the unfortunate events with the Capitol protest. Strangely enough, all of that occurring and the market still grinding higher. I think there's a little exaggeration to some of the headlines that the Democrats are going to be able to push legislation as easily. So that will remain to be seen because they will need every vote. And there are some moderate Democrats like Joe Manchin in West Virginia who don't always go right along with the party line. So they may inject and have a bit more of a say on how some of that legislation comes to pass. Some of the Republican Party has been very split over these recent events at the Capitol, and we may see that drives a deeper bipartisan partnership there than we've seen in a real long time. So kind of a crapshoot to see how this is all going to shake out. Certainly the next 2 years are going to have that Democratic policy tilt. And some of the changes to watch out for, and of course you've heard Jeff talk about it, the higher taxes, finally more spending, right? The awaited fiscal stimulus package that will aid in goosing the economy. Tighter regulation of business, not a surprise. And we are seeing some of that pressure already on tech companies. And there's going to be that drive for breakups of these monopoly-like companies. So again, despite all that, the market continued to push higher. And the market does rely very much on the government continuing to function effectively and reliably. So I think near term, here, sometime January, possibly early February, we could see that sell-off. There could be that news story. There's certainly a lot of stuff circulating out there with the FBI and some of the threats that they're hearing. And the fact of the matter is the market's been running hot. We've been running up for a good bit now, and we do need to let out some steam. So I see that choppiness, and I think the sooner that we get back to that reliable functioning Washington normal, the happier the market's going to be. So that's getting President-elect Biden installed and inaugurated with the least amount of drama possible. So that said, we're looking forward to, and we started to position back in December, the portfolios shifting into different sectors to take advantage of what I'd like to call the reopening theme. There's a lot of pent-up demand, right? People have been in their houses. I know for us, it's going to be, almost a year in March 23rd. That'll be a date burned on my brain that we decided, okay, work from home. So it's been a long time. People are looking forward to, the stimulus package, getting out, spending money again, being normal, eating out, doing all those things that we used to do. There's a potential infrastructure package that's now on the table. So all of this coupled with that pent-up demand is going to benefit some sectors more than others. So like I said, based on some of that rotation, we put money to work in the consumer discretionary sector. Recent outperformance there, the future upbeat upward revisions of GDP growth for the coming year. That and the stimulus, improved, an improved outlook there for that sector as all that money filters through. Similar for the industrial sector. That's going to be our pent-up business demand. The infrastructure package, and of course, overall better economic growth expectations. So we're going to be rotating some money into industrials from some of the other underperforming sectors. We started to rotate into financials. back in December. That sector benefiting from the steepening yield curve and also a lot less loan losses being reported by the banks. So that a release of some of those loan loss reserves is going to bode well for this sector. Also, international and emerging markets showing up in your portfolios. This is a sector that is set to outperform the U.S. this year. Combination of global stimulus efforts combined with the weaker dollar is delivering the right conditions for these markets to outperform the U.S., something I don't think we've seen since 2017. So nicely positioned there to take advantage of that. Also been a rotation from large caps to small caps. That's a sector that really has taken off this past fall. Still room to run there. So we've put some money to work. With the small caps, the valuations are just lower there. So looking forward to that trending higher as well in 2021. So all the above is a lot of positive news that we think is going to keep the market trending higher. Certainly that said, bumpy ride. There are always bumps. We've all seen the market, right? We go up, we let off a little steam, continue to push higher. No different. So the frothy market sentiment obviously creates risk. We've mentioned that we do expect some sort of a pullback here, January, early February, and then hopefully we'll start to benefit from all the good things that we expect from the economy this year. So we're watching carefully and we'll make any adjustments to the portfolios that we feel are needed to weather that or dampen that volatility. And some of the tactical positions that we've taken can do things like rotate or raise a little more cash during those periods of volatility, and that should help dampen things a bit. So barring any serious issues like you shut down restrictions, delayed vaccine rollout. Hopefully these will, I'm sure they're all going to be things that the Biden administration is going to be focused on getting under control. So, but barring any of those unexpected things, we think investors are going to stick with the markets, given the lack of alternatives, despite the frothiness, ultimately driving them higher throughout the year. So I hope that you found that informative. That's This Week in Wealth, and we'll look forward to seeing you next week. Thanks.